everyone. My name is Johan Vako. I'm the Vice President of Wealth Management at Wall Street Alliance Group. And with me is Sam Cohen, Chartered Financial Analyst and the Certified Financial Planner. We wanted to share our thoughts as conflict escalated between Israel and Iran, and we wanted to discuss what would be the impact on the economy. This escalation has impacted the global markets. Also, the major indexes fell this Friday as they were trying to price in this geopolitical issue. VIX, which is the volatility index, spiked about 13%, indicating the investors' fear. And of course, one of the things that stand out in the markets for the past few months at least is the high volatility. But that is normal, especially during periods of high uncertainties or geopolitical escalations. And we have seen those currently happening simultaneously in many fronts across the world, like in Russia, Ukraine, Israel, Iran, and it would be unwise not to account for this kind of escalations in the portfolio management approach. I'm saying that because as a certified financial planner, I've seen a lot of people who have concentrated positions on their portfolios. They have 4 to 5 high-flying stocks, which make up more than 60% of their portfolios. And in my opinion, this is very high risk, and this is not the right way to invest in the stock market. Our recommendation is to keep breadth in your portfolio. And this is something that our team have been calling since November of last year. We had shows on CNBC, Business, Fox News, when we spoke that once this post-election sugar high in the market wears off, we will see a pullback due to uncertainties with the immigration and the tariff policies. Now, there are certain events that no one can predict when they are going to happen, how long they will last. And conflicts like Israel-Iran is a prime example of that. Sam, would you like to shed some light on mistakes to avoid and sectors to be focused on right now?
Yeah, thank you, Johan. And I would certainly echo as a CFA what Johan is saying, right, in terms of increasing the breadth in your portfolio, right? And so issues like this, conflicts overseas, bring about the conversation again of the difference between systematic versus unsystematic risk, right? And what you never want to do is in your portfolio have too much unsystematic risk. So for your knowledge, unsystematic risk is essentially risk that's isolated to one individual company. Good example would be what happened with United Healthcare, right? That's something that was not impacting the overall market. That was more specific to their business, right? And so that can actually be reduced very greatly and very easily by just diversifying your portfolio. Now, market risk, right, tends to occur from more geopolitical type events, from things like recessions, right? This impacts all stocks across the board. Now, this is harder to reduce, but you can add additional hedges in the portfolio, right? So when there are geopolitical tensions, wars, conflicts overseas, you can add areas to your portfolio like oil, right? So the oil sector tends to do well when inflation is going up, when oil prices are rising like we're seeing today, and then also gold. And gold is seen as a safe haven asset, right? Typically, investors flock to that in times of uncertainty because it tends to hold its value quite well throughout any of these turbulent periods. So again, to reiterate what Johan said, it's very important to not put all of your eggs into the same basket, right? To remain heavily concentrated in technology in a few stocks. It's a huge mistake in today's day and age. What you want to do is, again, try to improve that breadth in your portfolio.
Absolutely. Thank you, Sam. Now, to summarize, as the Vice President of Wealth Management at Wall Street Alliance Group and as a certified financial planner, I've been doing it for a long time, and we have seen this kind of pullbacks occurring very frequently. And I believe that the major mistake that people make is that they sell in panic. Again, market will go down for different reasons. Once because there was a war, another time because of a dot-com bubble, then the housing crisis, then a recession, then stagflation, then a pandemic. But the end result has been the same. Market recovers and continues to go higher. So the best approach is to stay diversified and be opportunistic on those market declines. While markets have reacted sharply from this Israeli and Iran conflict, Historical patterns show that geopolitical tensions lead to short-term volatility, and then this is followed by a recovery. But if you need any assistance navigating through these high volatile times, here at Wall Street Alliance Group, we have a team of fiduciaries from CFAs, CFPs, actuaries, attorneys, all under one umbrella, who can assist you not only with your investments, but all your financial planning needs.